What if I told you, you don't need to be rich to start investing, but investing is how people become rich? Most people think investing is complicated, risky, or only for experts. But the truth is, once you understand the basics, you unlock one of the most powerful ways to build wealth. So in the next few minutes, I'm going to break down investing in the simplest way possible, so you can actually start. Let's make this simple. Investing means this. Instead of spending all your money, you put some of it into things that can grow over time. In other words, you stop working only for money, and you make money start working for you. That's the game. So where exactly do you invest your hard-earned money? It's the big question, but the answer isn't about finding one magic bullet. It's about understanding the different tools available to you, known as asset classes. Think of these as the foundational building blocks of your investment portfolio. Each one has a unique role to play, with its own potential for growth and level of risk. Let's walk through the main options that most beginners start with. First up, we have stocks, also known as equities. When you buy a stock, you're not just buying a digital ticker symbol. You are buying a small ownership stake, a share, in a publicly traded company. You become a part owner. If that company performs well, innovates, and increases its profits, the value of your share can increase. This is called capital appreciation. Many companies also share a portion of their profits directly with shareholders, which are called dividends. Stocks offer the highest potential for long-term growth, but they also come with higher risk and volatility, meaning their prices can swing up and down significantly. Second, we have bonds. If stocks are about ownership, bonds are about lending. When you buy a bond, you are essentially loaning money to an entity, which could be a corporation or a government. In return for your loan, the issuer promises to pay you periodic interest payments over a set term. At the end of that term, on the bond's maturity date, you get your original investment, the principal, back. Because they offer predictable income and are generally less volatile than stocks, bonds are often used to add stability to a portfolio. They typically offer lower returns than stocks, but they play a crucial role in managing overall risk. Third on our list are funds. This is a broad category, but let's focus on two key types for beginners: mutual funds and exchange-traded funds, or ETFs. Think of a fund as a basket that holds a collection of many different investments, sometimes hundreds or even thousands of stocks and bonds. When you invest in a fund, you instantly own a tiny piece of all the assets inside that basket. This provides immediate diversification, which is a powerful way to reduce risk. A mutual fund is typically managed by a professional who actively picks the investments. An ETF, on the other hand, often passively tracks a market index, like the S&P 500. Because they require less active management, ETFs and index funds generally have much lower fees, which can make a huge difference in your returns over the long run. And finally, there's real estate. This is an asset you can physically touch. The most common way people invest in real estate is by buying a home to live in, hoping its value increases over time. You can also invest by purchasing properties to rent out, generating a steady stream of rental income. While it can be a powerful wealth-building tool, direct real estate investing typically requires a large amount of capital upfront and involves hands-on management. For those who want exposure without buying property directly, there are also real estate investment trusts, or REITs, which trade on the stock market just like stocks and ETFs. Stocks, bonds, funds, and real estate, these are your primary tools. You don't need to be an expert in all of them, and you certainly don't need to invest in all of them right away. The first and most important step is simply to understand what they are, how they work, and the role each can play in helping you build your financial future. Now here's where things get powerful. It's a concept that Albert Einstein supposedly called the eighth wonder of the world. Compound growth. Think of it like a small snowball rolling down a very long hill. At first, it's tiny and picks up just a little snow. But as it gets bigger, it gathers more snow with each rotation, accelerating faster and faster until it becomes an unstoppable force. This is how small, consistent investments can become a significant nest egg over time. Here's how it works. You invest your money, and you earn a return on that money. But the magic happens in the next step. Those returns you just earned are reinvested, and they start earning returns of their own. Your money isn't just adding up, it's multiplying. Let's make this real with an example. Imagine you invest just $100 a month into a simple, broad market fund that historically averages an 8% annual return. After 10 years, you would have contributed $12,000. Your account, however, would be worth over $18,000. That's more than $6,000 in growth, created by your money working for you. It's a great start, but the real power is just beginning to build. Let's fast forward another decade. At the 20-year mark, you've put in $24,000. But your investment has snowballed to nearly $60,000. Notice the shift? Your growth, over $35,000, is now larger than the total amount you personally invested. Your returns are doing the heavy lifting. Now for the truly astonishing part. After 30 years, your total contribution is $36,000. But thanks to the relentless power of compounding, your portfolio could be worth around $150,000. Over $100,000 of that is pure growth. Money your money made. So, your money doesn't just grow, it accelerates. The growth in the last 10 years of our example was far greater than the growth in the first 20 combined. This is why time is your single greatest asset as an investor. The earlier you start, the more time your money has to roll down that hill, gathering momentum and growing exponentially. It's not about timing the market, it's about time the market. Now let's talk about risk. It's a word that can sound intimidating, but understanding it is the key to becoming a confident investor. Every investment has some level of risk. In simple terms, risk is the chance that your actual investment return will be different from what you expected. This includes the possibility of losing some or even all of your original investment. But it's not just about losing money. It's also about the ups and downs your investment value might experience along the way. This is called volatility. The fundamental principle of investing is the relationship between risk and reward. Here's the rule. Higher potential reward usually comes with higher risk. Why? Because investors need to be compensated for taking on greater uncertainty. If a riskier investment didn't offer the chance for a higher return, no one would choose it over a safer option. For example, stocks can grow fast because you own a piece of a business with unlimited upside. But they can also drop when the company or the market faces challenges. Bonds, on the other hand, are more stable. They're like loans you make to a government or corporation, providing steady interest payments. Their growth is slower and more predictable. This trade-off is central to building a portfolio. Your willingness and ability to take on risk depends heavily on your time horizon, how long you have until you need the money. If you're investing for retirement in 30 years, you have a long time horizon. You can afford to weather the market's short-term storms, known as drawdowns, for the potential of higher long-term growth. History shows that while markets experience downturns, they have always recovered and reached new highs over the long run. However, if you need the money in 2 years for a house deposit, your time horizon is short. A major market drop could be devastating, as you wouldn't have time to wait for a recovery. This is why your timeline is one of the most important factors in deciding how much risk to take. The goal is not to avoid risk completely. That would mean avoiding investing altogether and missing out on growth. The goal is to manage it intelligently, aligning your investments with your personal financial goals and time horizon. This brings us to a very important concept: Diversification. In simple terms, don't put all your money in one place. Spread it across different investments. So if one goes down, others can keep you stable. This is how smart investors protect themselves. Here's something most people don't realize. You don't need a lot of money to start investing. You can start small. What matters is consistency. Invest a little, regularly. Over time, it builds up. And thanks to compound growth, it builds faster than you think. If you're just starting, keep it simple. Start with mutual funds or index funds. Invest every month. Reinvest your profits. Be patient. That's it. No complicated strategies, no guessing. Just discipline. Here's the truth most people ignore. The biggest mistake is not losing money in investing. It's never starting at all. Because every year you wait, you lose time. And time is the most powerful asset you have. So start small. Start simple. But most importantly, start now. If you found this helpful, make sure to like, subscribe, and stay tuned. Because your financial future starts with what you learn today.